Hello and welcome to this Astranti video. Now this is a highlights video. So this is something a bit different from what we normally do, but I don't know if you're about to sit your ACCA Strategic Business Leader exam. If you are, you may be getting a little bit nervous. You may be thinking, I don't know how best to spend my time before the exam. Well, luckily for you, you're in exactly the right place. This video is perfect for you because you're going to gain a really strong understanding of the pre-scene. Now, I mentioned it's a highlights video, and that's because it's going to be showing you the highlights from 3 videos. Well, in fact, it's actually from a series of 5 videos that we here at Astranti have prepared for you on this forthcoming pre-scene. Now, the videos themselves, as I've mentioned, are a series of 5. The first 3 are a line-by-line analysis of the pre-scene, drawing out all the most important bits of information and explaining any areas that you may be a little bit uncertain by. So, let's take a first look at the highlight from the pre-scene analysis. And so we're going to carry on moving through the industry body, the stakeholders, the challenges and risks, before leaving the kind of industry overview behind and turning our attention to Merceh itself. So its background, its mission, its ownership and governance. And then we'll continue the rest of looking at Merceh in video 3. So in reality, when we start looking at Merceh in this video, that's where our strategic oversight begins. And it's also where many SBL requirements are actually rooted in kind of stakeholder tension and regulatory exposure and board level accountability. But as you can see, we've got our red text, our red annotations from our previous video, and you can see that we have no markings yet on industry body, and that is where we are going to begin. Okay, so in this industry body section, we find out that in Darland, it is the regulator of the magazine industry is the Newspaper and Magazine Standards Authority, the NMSA. So they're the ones in charge of setting standards and investigating complaints, and would be able to impose corrections or fines for any breaches of their regulations. So, as I mentioned in the introduction, you can see with this paragraph, we are moving from economics to governance. So the NMSA isn't just a professional body issuing optional guidance. It's got actual enforcement authority. So it can investigate complaints. We're going to find a bit. There we go. Require corrections and also impose fines on magazines for any breaches of regulations. So it's not purely reputational, or I should say that content risk isn't purely reputational. It is financial and regulatory because the NMSA can do something about it if a magazine publisher falls foul of its code. So really notice the scope of the NMSA: accuracy, offensiveness, controversial issues, and employee behavior. So that covers editorial standards and internal conduct. So compliance is both a content issue and a cultural issue. So strategically, this places responsibility at board level. So if inaccurate or misleading content is published, the consequences go beyond editorial embarrassment. They can actually affect brand trust, subscriber retention, advertiser confidence, and then financial performance. And this also kind of creates risk asymmetry because a single high-profile breach could have a disproportionate reputational impact relative to the size of any fine. So if you see an exam requirement around risk management or internal control, governance effectiveness or ethical culture, this paragraph this information, pardon me, is going to be foundational. Okay, so let's move down to stakeholders now, and you can see really what we've got are a list of stakeholders. I can't just quite get them all in, which is always frustrating, as well as the title. So you can see really we've got a wide stakeholder network, from readers to digital platform providers to investors, and then of course we got our regulator right at the bottom there. So what does this list tell us? Well, actually it tells us something really important, that we're not looking at an industry, or a company I should say, with a simple two-party business model. It is a multi-sided ecosystem. Readers want quality, credibility and value. Advertisers want reach and engagement. Authors want freedom and remuneration, and suppliers want stable contracts. Investors want returns. Regulators want compliance. Digital platforms want commission and data control. And of course, one of the issues is that those interests are not always going to align. So for example, advertisers may prefer favorable product reviews or specific editorial positioning, but editorial integrity and regulatory compliance demand independence and accuracy. Similarly, digital platform providers are going to hold power over distribution and data access, whilst the regulator holds power over content standards. And so what we're seeing, or what this is creating, is a strategic tension at board level. So directors are going to have to balance commercial pressure with ethical and regulatory obligations. Now, it's also worth noting the breadth of external dependency: paper suppliers, printers, distributors, retailers, and digital platforms. And that's a really wide supply chain exposure. So we can see that this industry is structurally interconnected. So again, if you're thinking back to the exam and you're thinking about a requirement around stakeholder management, governance effectiveness, or ethical risk, then this is the kind of information you'll be using that will be central to your argument. Anyway, we're going to return to the subject of stakeholders in our strategic analysis video. That strategic analysis video is our fourth video in this series, where we move away from the pre-scene and instead take the information from the pre-scene and feed it through models and tools, much like Mendelow's matrix. So you'll be seeing these stakeholders again, and we'll give them some kind of order and kind of work out what these stakeholders would mean for Merceh. But we'll do that in video number 4. Meanwhile, we can scroll down and move on to industry challenges. And look at all this lovely blank space. This is so much easier to annotate than video 1, which makes me very happy. I realise how sad that makes me. But okay, we've got some industry challenges now. Okay, so in this section, the industry challenges section, we're dealing with the first kind of paragraph, or the first sentence, if you like. And really, this sentence kind of crystallizes everything that we were talking about in video 1. Because the issue isn't that print demand is declining. Or I suppose it's not simply that print demand is declining, pardon me. It's that lost print revenue has to be replaced. Now that changes the strategic framing entirely. So growth in digital is not an optional expansion of going, oh, this would be nice if we got into this area. It is a defensive replacement of a shrinking revenue base. And replacement is harder than growth. But why is that? Well, because digital pricing may be lower, digital advertising yields may differ, and digital distribution often involves platform commissions. So the board's challenge is not, in kind of inverted commas, to grow digital. It is to grow digital at sufficient scale and margin to offset structural print decline before fixed costs create margin compression. So this is a timing problem as much as a strategy problem. So if digital transition lags revenue decline, operating leverage accelerates deterioration. Now, this is a classic structural transition risk, and it sets up almost every possible strategic requirement you could see in the exam. So restructuring, investment appraisal, divestment, platform upgrades, cost rationalization. This is basically a battlefield. Okay, so let's move down now to the second paragraph in industry challenges. And what we find out here is that kind of free online content is increasing competitive pressure. And that means publishers are having to justify the reason for paid subscriptions through kind of superior quality and differentiation. So we've got a kind of classic substitution pressure. So when content is available online for free, the benchmark price is 0. So that fundamentally changes the kind of economics of the industry. Just lost my marker again, there we go. So publishers have to offer something materially better, whether it's deeper insight or trusted opinion or exclusive content or community identity or superior user experience to justify charging. And I'll pop those as a little note on the bottom right hand screen there for you. So what we're seeing is in this paragraph the kind of shift in competition from content availability to instead content differentiation and credibility. And it's also going to raise the bar for editorial standards. So if readers can obtain basic information elsewhere at no cost, only premium quality material sustains subscription willingness. So a single reputational breach in a market full of free substitutes makes switching simply effortless for readers. So again, thinking back to the exam, if you see a requirement about competitive strategy or sustainable advantage, this paragraph is going to sit at the core. And it doesn't get any better, although the industry challenges section always makes it seem like the sky is falling in these case studies. But obviously, in this paragraph, we find that advertising income is also under pressure because print readership is on decline and digital advertisers have possibly kind of alternative and maybe more appealing channels to advertise on. Now this is something we spoke about in video 1, and basically this paragraph is reinforcing that the revenue problem is, I've just lost my marker again, is two-sided. So print readership is declining, advertisers are less willing to pay for print advertising. I just made a couple of notes. I just want to make sure you can see that this belongs with this paragraph and this one with this paragraph too. So what we're seeing is a direct reduction in advertising yield, but the digital solution isn't guaranteed either. So even if publishers grow digital audiences, advertisers may still prefer the alternative digital platforms, the social media, the search engines, or specialized digital networks that offer superior targeting, analytics, or reach. So the magazine publisher is squeezed. Print advertising declines with readership, while digital advertising competes with powerful tech platforms. So publishers must attract readers to attract advertisers, but attracting readers requires investment in quality and platform capability. And advertisers have far more alternatives in digital than they ever had in print. So when we think about strategic options, digital growth alone is not enough. The digital advertising proposition must be compelling relative to tech competitors, and that significantly raises the strategic bar. And I've popped that on screen for you as well before we move on to the final paragraph, where we find out that the magazine industry is in a constant state of consolidation, takeovers or buyouts of publishers or rights to publish particular magazines occurring regularly. So what we're seeing here is that consolidation changes the competitive landscape. When industries consolidate, scale becomes increasingly important for cost efficiency or bargaining power with suppliers or advertising leverage and platform investment capability. And this creates an acquire or be acquired dynamic. So stronger players grow through acquisition and weaker players become targets. For Merceh, I think I'm changing the pronunciation every time I say it. Obviously, this is both an opportunity and threat. And again, we'll come to our SWOT analysis in video 4. But the opportunity is to acquire smaller publishers, increase market share, spread fixed costs. But the threat is become a target if performance weakens or strategic direction falters. But consolidation also introduces risk. So acquisitions bring integration challenges like cultural alignment or platform compatibility or redundancy costs and overpayment risk, all those kind of things. And as we'll see when we examine Merceh's background, it has already participated in that consolidation process. And that's going to raise questions about integration, effectiveness, and whether further acquisition is part of its forward strategy. Okay, so there we go. That is our industry challenges section, and I think we've covered quite a lot of information there. I'm just going to pause us here in a second and just chuck up a few takeaways from this section because we covered quite a lot of stuff. So, what do the industry challenges actually mean? Firstly, this is not cyclical weakness. It is structural print decline. Lost revenue must be replaced, not simply recovered. Digital growth must offset both subscription and advertising erosion before fixed costs compress margins. Secondly, publishers face intense substitution pressure. Free online content raises the competitive bar, while digital advertising competes not just with other publishers, but with powerful tech platforms offering superior targeting and analytics. And that squeezes the traditional publisher from both sides. And thirdly, the industry is consolidating. Scale is becoming more important for cost efficiency and bargaining power. Stronger players expand, weaker ones become targets. So the environment Merceh operates in is not stable. It is economically pressured, competitively intensified, and structurally reshaping. So there we go. It does make it all seem a bit doom and gloom, doesn't it, the industry challenges section? And I don't think this section is going to make us feel a lot better. I don't think we're going to want to open a magazine publishing company after going through this section, because obviously this is our potential risk. And what are the impacts? What are the impacts, pardon me, there we go, section. Okay, so let's look at the first set of risks, which is production of poor content, and that can damage reputation, reduce readership, and obviously lead to loss of sales and advertising revenue. So obviously content is the product. If quality deteriorates, then reputation suffers. And we've got a market with an abundance of free substitutes. And so reputation is everything. Loss of readers directly reduces subscription income. But remember, we've got a two-sided model. So it's also reducing the advertising revenue because advertisers are paying for reach and engagement. So poor content creates compounding financial damage. And this is not only about editorial incompetence. It could arise from cost cutting, over-reliance on freelancers, rushed deadlines, inadequate editing, or pressure to prioritize volume over depth. And at board level, this isn't an editorial issue. It's a strategic asset protection issue. Content credibility underpins the entire revenue model. So if you see a requirement around risk management, internal controls, or strategic sustainability, this is going to be one of the most examinable risks in the case. So there we go. That was the pre-scene analysis. 3 videos really getting to the detail of the pre-scene. But there's 2 more videos in this series, and the first of those is the strategic analysis video. Now, one of the key elements of this ACCA SBL exam is that you are able to use key models, key theories, key tools when analyzing your company. Now, that can be a really hard thing to do when you've just learned about the company, when you've just found out who they are. So here at Astranti, we've done the hard work for you, and that's what you're going to find in this clip from our strategic analysis video. Okay, so let's go to the mission first, and we're going to work through 4 elements of the mission here, which is purpose, strategy, values, and policies. And really this framework shows how strategic kind of intent translates into operational commitments. So let's start off with the purpose, and we've got 3 questions on screen for purpose, and our purpose is to enhance readers' lives through expert provision of information which engages, enables, and entertains. So this is really reader-centric. It's not shareholder-centric, it's not revenue-focused, it's about reader value. And there's 3 action verbs: engage, enable, and entertain. Now, strategically, this positions Merceh as more than a content provider. They're claiming to deliver expertise and practical value. And that raises the bar for content quality and creates a credibility obligation. But if content quality declines or expertise is questioned, then the mission becomes hollow. Now, the use of expert provision directly links to regulatory risk. So inaccurate content is going to contradict the stated mission and expose Merceh to the NMSA sanctions. Okay, then let's move on to strategy. So how will the organisation compete? So the strategy we've got is create reader-centric, expertise-focused and quality content. So this is how they intend to deliver the purpose, really. Reader-centric means understanding reader needs, not just producing kind of content. Now, expertise focused means leveraging specialist authors and established editorial authority, and quality content means accuracy, depth, and regulatory compliance. But notice what's not in this kind of strategy area. There's no mention of advertising or shareholders or operational efficiency. Strategy is pure content focus. So that's alignment with purpose, but also reveals kind of potential tension if commercial pressures like advertising dependency compromise editorial independence. Okay, then what have we got about values from the mission statement? Well, we think about sustainability, employee development, and diversity, which we saw about in the pre-scene. So values really create stakeholder expectations and act as benchmarks for board decisions. But really, the evaluation angle is, are these aspirational statements or kind of operational commitments? Then we have policies, just making sure that people act to the values, strategy, and purposes standards. And with policies, we've got things like the ethical code, data protection, and hybrid working. So really, these are the areas where values become operational rules. So we've got our ethical code, which includes NMSA compliance provisions. I mean, the code exists, but enforcement mechanisms aren't detailed. So this could be seen as kind of classic existence versus effectiveness governance questions. Compliance is stated, but monitoring and consequences for breaches aren't specified. Then we've got data protection, so a subscriber database operating in line with regulations, which is critical for regulatory risk management and subscriber trust, particularly important because as digital begins to grow, data collection is going to grow with it. And then we've got hybrid working. So this gives operational flexibility and potential cost reduction, but it does require strong digital infrastructure. Creates also coordination challenges across the 8 divisions like we spoke about in the pre-seen videos. So there is a trade-off between flexibility and cohesion. So there we go, there's our mission, and we can see that Merceh has clear mission, values and policies, but the strategic question is really about the alignment between the stated principles and the operational delivery. Okay, let's move on now and talk about the balanced scorecard. Okay, as I'm sure we all know, the balanced scorecard translates strategy into measurable objectives across 4 perspectives. So let's work through each quadrant systematically, focusing on what matters most for Merceh's transformation. So let's start off with, gone too far there, the financial perspective. So these are the financial metrics. And what we're going to be doing here with the metrics on screen is tracking both growth and composition, so not just absolute numbers. So we've got revenue and revenue growth. So we know that total revenue has slowed recently. So when a business in structural transition sees growth slowing, it suggests the legacy model is weakening faster than the new model is scaling. So basically a kind of warning signal. Then we've got operating profit margin. We think this has fallen, don't we? That's really important because revenue can grow whilst margins compress. So if you're spending heavily to acquire digital subscribers, or if fixed costs aren't adjusting to lower print volumes, then margin compression despite revenue growth tells you something about cost structure inflexibility. Then we're looking at the split of revenue, publications versus advertising. So this is where the strategic risk becomes really visible. So publication revenue is declining whilst advertising revenue grows. And as we spoke about, that shift increases dependency on advertising income, and that is more volatile and more sensitive to economic cycles. Now, subscription revenues provide stability, and losing that stability is dangerous. And we've also got print's kind of split versus digital. So this is within the publications revenue. So if digital isn't growing fast enough to offset print decline, then you're just managing a shrinking business, really. Then we've got free cash flows. So cash is what funds transformation. If margins are compressing and working capital is tied up in paper inventory, where does the cash come from to invest in things like platform upgrades? Cash flow constraints kill digital transformations. So basically what we've been seeing here is the kind of commercial acumen, connecting financial metrics to strategic choices and trade-offs. Okay, now let's go over to the learning quadrant. And the first one on screen is the staff turnover. So think about this kind of learning and growth perspective as the kind of capability foundation. So we're starting with staff turnover. So we know that publishing is really talent dependent, and high turnover weakens content quality, institutional knowledge, as well as editorial continuity. Now in a transformation, you need stable talent whilst building new capabilities. Then we've got digital skills training investment. So obviously this kind of transformation we're talking about requires capability development. So editorial teams have to adapt from print first to digital native thinking. So without investment in upskilling, cultural and capability barriers slow down the transformation. So this needs to be measured in investment per employee and skills acquisition, not just kind of training hours delivered. And then we've got employee engagement. So engaged employees drive productivity and innovation, and disengaged employees resist change. Now, in structural transition, engagement predicts execution success. Okay, now let's go to our internal process perspective. So this is where kind of operational efficiency and quality sit. And the first thing we've got on screen is print production efficiency. So as print volumes decline, can you maintain efficient production runs, or do shorter runs increase unit costs? Now, in-house printing made sense at higher volumes, but at lower volumes, the economics change. So this metric tells you whether vertical integration is still rational. Then we've got delivery performance, so on-time delivery and returns. So late deliveries damage retailer relationships and subscription retention, and high return rates signal quality problems or distribution failures. Now, in a declining market, operational excellence becomes far more important. It's not becoming less important. And then we've got content quality. Then we've got platform uptime, platform uptime or reliability. And that's because digital subscribers expect continuous access. You don't think it's going to turn off at 10 o'clock or be intermittent. So platform outages increase churn risk immediately. One major outage could trigger subscriber exodus to free alternatives. And then finally, we've got content quality and regulatory compliance. Now, this is all about reputational and legal risk combined. Poor content drives subscriber churn and advertiser withdrawal simultaneously because you have a two-sided revenue model. Track complaints to MSA, correction rates, and plagiarism instance, because content quality is the product, and without it, nothing else matters. Okay, and then our final quadrant is customer. Okay, so let's bring up the metrics. So with customer, now obviously these customer metrics are the ones that are directly driving revenue sustainability. So first off, we've got subscriber numbers, and that's print and digital. So volume matters obviously, but direction probably matters more. So digital subscribers have to grow fast enough to replace print subscriber losses, and not just in volume, we're also thinking in lifetime value. Then we've got our digital subscriber churn rate, and this is really important metric because in subscription businesses, churn determines everything. High churn means acquisition spending compounds without building a kind of sustainable base. Now, if churn is high, you're just pouring water into a leaky bucket. Now, if we think back to our professional skills and we think about skepticism, here's a skepticism point for you. Is churn even being measured rigorously? How is it defined? What exactly does a subscriber count as churned? So that's something to think about as we move on now to website visitor numbers. So traffic drives both advertising revenue and subscriber acquisition. But visitor numbers alone are just really a kind of vanity metric. So what matters is engagement quality and conversion rates. So 1 million visitors who bounce immediately is worth far less than 100,000 engaged readers. And then we've got print edition sales volume. So this is the evidence of structural decline, really. So print volumes are falling steadily from, I think it was around 4 million to 3.2 million. So it's not cyclical, it's permanent. And falling print volumes hitting fixed print infrastructure, as we've spoken about, create margin compression. So there we go. There's our balanced scorecard. So we see this kind of holistic view of the organization. And then we can move on. So let's zoom out of balanced scorecard. We need to zoom out a little bit further than that. And we are going to zoom in to governance. Okay, what we're going to do here is kind of work through governance best practice areas, kind of one at a time, and obviously we might not be able to answer all of them from the pre-scene, but we'll say whether we can or whether we don't think we can or not. So the very first one on screen is a separate chairman and CEO, and we can say a resounding yes to this because the pre-scene explicitly states separate roles. An independent chair leads the board and the CEO manages the executive operation. So this is basic good practice. Separation, of course, prevents power concentration and enables independent challenge. So no concerns here. That is a strength. Then we've got independent NEDs. Now, we've said yes for this, of course, because we know the board composition is 50-50 executive to non-executive split. All 5 NEDs meeting independence criteria, independent chair confirmed. Now, what we should say here is, of course, well, the balance looks good on paper, but are there any digitally independent NEDs? Because, of course, we're talking about this structurally transitioning industry. You do need that digital expertise at board level, which the pre-scene doesn't seem to remember. But in terms of independence, they do seem to have the split, but whether they've got the correct experience, well, that could be up for question. Okay, then audit, nomination and remuneration committees. Yes, the pre-scene states all 3 committees are in place in line with Dana's corporate governance code, so compliance is achieved. But apart from their existence, we don't know really about effectiveness because, of course, there's no things like minutes available or how often do they meet and the quality of the challenges, all that kind of stuff. So all we can say is that committees exist. We can't assess their effectiveness, and again, really that's quite a good trait of skepticism. Then we've got risk management focus. And now we could say, I've said yes for this on screen because we know the committee exists, which is actually beyond minimum code requirements. And of course, that is good. We also know there's industry risks identified and disclosed in risk table. But again, I suppose similarly to the previous section, again, we're not sure of the effectiveness. And again, one thing I did flag in the video when we looked at the risk management table was there was no differentiation for Merceh's specific strategic choices like in-house printing and platform dependency or geographic concentration. So it does suggest risk reporting may be generic rather than tailored, but that would be my kind of reading between the lines evaluation rather than actually just stating what's there in practice. Okay, then we've got directors, disclosures, of directors and pay. And again, it's not mentioned in the pre-scene. There's no disclosure of remuneration, structure, the long-term incentives, or performance linkage. Then we've got financial reporting and control. Now, I put this down as unclear. Now, we do know in the pre-scene, that the board considers Merceh's administration and accounting systems to be sufficient for its current wording. Now, the reason why I've put this as unclear is because of a point we made when I spoke about this. We spoke about it being sufficient. So in a business undergoing structural transition, sufficient for current may not be sufficient for future. And we did also pick out a few KPIs that potentially were missing. So again, maybe I've been a bit harsh there. Maybe we could say yes, but perhaps there could be scope for more, but I've just put unclear. Okay, information for directors, I've also gone unclear because it's not detailed in the pre-scene. All directors involved in decision making, I've put yes, but again, we should be a little bit cautious because although we do have that formal structure which does suggest involvement, actual practice isn't evidenced. So again, that's something to be aware of. Regular meetings with institutional shareholders, I've put that as unclear. Now we know the pre-scene states that there's institutional investors holding 60%, but there's no kind of mention of engagement frequency, the AGM participation, or investor relations activity. And then finally, the use of AGM, I've put unclear because again, it's not mentioned in the pre-scene. No reference to AGM practices, shareholder engagement, or accountability mechanisms. So what we've done here is we've assessed Merceh's governance systematically against best practice. We see some elements are strong, some elements are unclear, and these could be areas in which we need to be looking out for in the pre-scene, so just be aware. Okay, let's zoom out now of governance and we can move into the ethics and CSR issues from the pre-scene. So we're going to be looking at three key ethical considerations for Merceh and then 3 key CSR issues. So first, let's bring up the ethical issues. And the first of those is NMSA regulatory compliance. So we know that Merceh operates under industry regulation covering content accuracy, offensiveness, and employee conduct. So compliance isn't just an ethical obligation, it's actually a commercial necessity. Breaches result in fines, reputational damage, and advertiser withdrawal. And the ethical code explicitly includes NMSA provisions demonstrating awareness of regulatory exposure. Secondly, we've got editorial independence versus commercial pressure. So advertisers may prefer favorable reviews or editorial positioning, and that's going to create tension between revenue generation and content integrity. So Merceh's community positioning and mission around expert provision require editorial independence to be credibly maintained. So it's not just about ethics, it's strategic asset protection. And then thirdly, we've got data protection and subscriber trust. So handling subscriber data compliantly protects against regulatory fines and reputational harm. But ethics extends beyond compliance. So using behavioral data responsibly, if we are collecting it and maintaining transparency around data usage, builds long-term trust in a market where, as we saw earlier on, switching is effortless. And in fact, we will come to when we look at Porter's 5 Forces 2. So there we go. That was our strategic analysis video, but we have one more. And this is one of our most popular videos. This is our top 10 video issues. So in this top 10 video, we identify what we think, using our expertise and our experience, what we think are the most likely issues to appear in the exam based on our analysis of the case study. And then what we do in this video is we highlight to you the issue's relevance. Then we kind of come up with some ideas of how the examiners may test that information, what forms the questions may take. And then we show you which bits of the case study we would look to answer those questions most effectively. Take a look. And in this video, the top 10 issues that we think you're most likely to face in your pre-scene exam is the final one and perhaps the most important. Well, maybe not the most important, but perhaps the most useful in shaping your revision. Because what we do in this video is we've got 10 specific issues. And why do we think these are the ones that you're likely to encounter? Well, that's because over the years, we have supported tens of thousands of students through case study exams. We know what to look out for, and we know what the examiners target. So these aren't just random picks. They're issues that keep coming up, or they're perhaps issues that we think will be a really good way for the examiners to test you, or perhaps a really good way for you to demonstrate commercial awareness, perhaps your ability to balance competing priorities. So really kind of brilliant ways the examiner could test you. Now, we know what we're dealing with, don't we? We know that Merceh is a magazine publisher that's kind of existing within a structural transition. Print is on the wane, it's declining, digital has to grow, and every strategic choice kind of seems to involve trade-offs. So the exam is going to test you in some way in navigating that complexity. So there we go, that's the reason for this video. What we're going to do is introduce you to the issue, introduce you to the areas that might come up kind of within that kind of context. We're going to talk about things that you should talk about if it does come up, and then we're going to link you to some theory and syllabus so that you can brush up on it if you need to as part of your revision. That's why I think it's such a great revision tool. But that being said, let's get started with issue number 1. These are in no particular order, so it's just issue number 1, which is our print decline strategy. So why have we chosen the print decline strategy as issue 1? Well, why does print decline matter? Well, because the pre-scene explicitly calls it the quotation marks most significant challenge, close quotation marks, facing Merceh. And look at the numbers on screen. Print volumes have fallen 20% from 4 million to 3.2 million units. So publication revenue peaked 3 years ago and it's now declining. So this isn't a blip. As we said throughout all these videos, this is structural. And that means that Merceh is going to have to completely rethink their business model, revenue mix, cost base, which titles they should keep investing in. And here's why examiners love this issue, because it tests whether you can distinguish between cyclical problems that recover and structural shifts that are permanent. Now you can see some likely issues on the screen already. So likely issues that may come up within this topic. So when the exam question touches on print decline, expect it to focus on strategic choice. So that means evaluating options. Do they defend the print base? Do they accelerate digital migration? Do they run a dual model? Portfolio prioritization matters too. With 300 titles, which ones would justify continued investment? So growth priorities would definitely come up in this area. Where should Merceh focus resources for future revenue? And cost restructuring is also critical because in-house printing creates fixed costs that don't decline as volumes fall. So that's operating leverage risk, and it's something we saw time and time again, or we've mentioned time and time again because it keeps coming up from the pre-scene. Okay, let's have a look now at the key points to raise. So how do you score marks in this area? Firstly, you've got to quantify the risk. Don't just say print is declining. Put numbers on it. How much revenue? How many customers? What margin impact? That's showing your professional skill of commercial acumen. Secondly, propose clear strategic choices with priorities. Don't list 10 things they could do. Pick the 2 or 3 that matter most and explain why. And that's another skill of evaluation. And thirdly, show how you'd implement milestones, resources, accountability, and remember to link everything to KPIs so that progress can be tracked. And finally, address execution risks honestly. What could go wrong? How do you mitigate that? And then, in terms of relevant theory we need to draw up, well, you'll notice a lot of it was in our strategic analysis video. That's why that's so useful. But you'll be looking at things like PESTEL for the external environment, Porter's 5 forces for the competitive pressure, SWOT for the internal and external factors, and for strategic options, Antoff's matrix shows growth directions and SAF criteria, suitability, acceptability, feasibility, tests whether choices are actually realistic. Now, risk assessment frameworks help you structure strategic risk analysis, and Kotter's change model applies because transforming a print-first business is organizational change. So use frameworks to structure thinking, not to show off. So there we go. There's our issue number 1, the print decline strategy. Issue number 2 is digital monetization. So really what we're talking about here is kind of revenue replacement. Because Merceh has to answer the question, if free content is everywhere online, why would anyone pay for ours? Now, the pre-scene tells us total revenue is flat despite advertising growth. And that means digital subscription revenue isn't growing fast enough to offset print decline. So digital monetization becomes make or break for the business model. So what are the likely issues? Well, expect questions on paywall strategy. What content sits behind the paywall, hard paywall, or metered? What pricing tiers? These aren't just product decisions, they're strategic positioning decisions. So premium tiers and bundles determine revenue per subscriber. Now, conversion management is huge. So you've got website visitors, but how do you convert them to paying subscribers? And churn reduction may be the most important metric they're not tracking yet. High churn means you're pouring marketing spend into a leaky bucket. Now again, these are all issues we've touched on throughout all the videos, including the strategic analysis. So what issues would you raise in this scenario? Well, you want to start with value proposition. So be specific about why readers will pay archive access, ad-free experience, exclusive content, expert analysis. So vague statements like quality content, they don't score marks. Concrete value drivers do. Pricing logic matters. So don't just suggest tiered pricing, explain the tiers, explain the rationale, explain how you test it. A/B testing, conversion funnels, churn prediction models. This is where analytics capability becomes critical. Now, operational impacts are often overlooked by weaker candidates. So if you're moving to premium digital, what does that mean for content curation? What does that mean for marketing capability, platform features? So you need to connect the strategy to the operating model. And in terms of regular or relevant theory, you're really drawing from digital business models and competitive strategy here. So value proposition design, which is identifying what drives customers' willingness to pay, that's going to be central. And obviously, Porter's generic strategies help explain differentiation against free alternatives like we covered in the strategic analysis video. Now, technology and data analytics are also crucial. So predictive analytics for churn, for customer segmentation, data-driven decision-making. And professionally, this tests commercial acumen heavily. Pricing strategy, revenue optimization, lifetime value calculations, that's 20% of your marks right there. And customer metrics like LTV and churn rate, you need to know. Okay, let's move on now to issue number 3, which is advertising redesign. Now, what we're doing here is addressing a dangerous dependency. Look at the trend. Advertising revenue is growing, but publication revenue is on the decline. And that means Merceh is becoming more and more reliant on advertising income precisely when its circulation base is shrinking. And advertisers have got really powerful alternatives now. They've got Google, they've got Meta, they've got programmatic platforms with superior targeting. Merceh has to prove its value or lose that revenue stream too. So let's have a look at the likely issues. So questions are going to likely focus on proving audience value to advertisers. So can Merceh demonstrate engagement, not just reach? Demographics, targeting capability. Advertising packages need redesigning for digital. Native advertising, sponsorship, formats beyond display. Brand safety becomes critical when editorial reputation is your differentiator. And measurement, proving return on investment, determines whether advertisers renew. So what kind of key points should you be raising in this section? Well, your answer really should articulate a digital advertising proposition that's genuinely competitive. Leverage audience insights, engagement data, and targeting that tech platforms can't match. Trusted, contextually relevant environments. So trust and safety, they aren't just compliance, they are competitive advantage. Editorial standards, brand safe content, moderation. These differentiate Merceh from open platforms. Position it as value, not cost. And revenue balance is strategic. So if advertising dependency increases, what happens in an economic downturn? Diversification through subscriptions reduces that volatility, and competitive positioning against platforms requires honesty. You can't out-target Google, but you can offer trust and context and the editorial quality that they just don't have. And in terms of relevant theory, again, we're seeing Porter's generic strategies and competitive advantage theory to explain differentiation. Value chain analysis shows where Merceh creates unique value versus platforms, and performance measurement through advertising KPIs like CPM and CPC, viewability, engagement rates, they prove effectiveness. And also stakeholder analysis, that's going to address balancing the kind of reader and the advertiser interests without compromising editorial. And don't forget ethics. That comes up here too, because transparency in native advertising, maintaining editorial independence under commercial pressure are all ethical issues. And again, this kind of creates a tension, and that's a nice area for examiner to test. Okay, number 4 is M&A decision. So really what we're thinking about here, when we're thinking about M&A, is accelerating our capability development. Now, of course, for those of you that have watched the strategic analysis video, you'll know that M&A matters because the magazine publishing industry is consolidating. The pre-scene tells us that Merceh itself expanded through acquisitions, and consolidation is the common response to structural decline. Scale spreads fixed costs and accelerates capability development. So, what kind of issues might pop up here? Well, questions would typically focus on acquisition rationale. Why this target? What's the strategic fit like? What capability gaps are you trying to fill? Or are you trying to consolidate the market? Now here, valuation drivers are critical. Revenue synergies, cost savings, integration costs. Examiners want you to challenge the numbers, not accept them. An integration risk is where most acquisitions fail. Systems or culture or people or processes. And don't forget, disposal decisions are often neglected. Sometimes selling underperforming titles is the right move, just like we spoke about in the methods of growth in the last video. So what issues should you raise? Well, firstly, you want to carry out a strategic fit assessment. Does this acquisition align with corporate strategy? Does it fill genuine gaps or just add size? That's where your professional skill of evaluation comes in. Then you want to challenge assumptions. Now, synergy estimates are always optimistic. Test them. Integration timelines are always too short. Acknowledge that. Feasibility matters as much as financial return, and this is your skill of skepticism. Don't accept management's business case at face value. So your due diligence scope needs to go beyond financial. You want to be thinking about legal risks, technology compatibility, key person dependencies, cultural fit. These are where hidden problems emerge. So your integration approach should show governance and planning and risk mitigation, not just, well, this is how we'll integrate, but by how? By when? Who's accountable? What could go wrong? And in terms of relevant theory, really, you want to be thinking about strategic frameworks like Gantov's matrix for growth methods, BCG for portfolio management, and then finance theory covers valuations, DCF, multiples, synergy analysis, investment appraisal using NPV and IRR. And risk management frameworks, structure, due diligence, and integration risk assessment. Change management theory, especially Kotter's model, that applies because acquisition is organizational change. And governance theory explains board oversight of major transactions, role of audit committee, and conflicts. So there we go. There's our top 10 issues, and there's our video focus on the ACCA SBL. Really analyzing the pre-scene and then applying all the key models, the key theories, and then demonstrating to you what we think is most likely to come up in your exam. Now, to accompany these 3 videos, we also produce an industry analysis. Now, this is a large document that's going to explain to you everything you need to know about the industry. And alongside that, we've also prepared 2 mock exams to make sure that you can practice using your newfound knowledge before you come to the exam.